Welcome to Nightlife, the first hour.
You might be one of the millions of people who dipped into your super last year to help you get through the financial stress inflicted by the COVID-19 pandemic. I mean, the government's early withdrawal scheme was judged a big success. I mean, fortunately, many people have been able to get back on their feet. They're also keen to replace some of the money they took out of their super. Well, the Australian Tax Office has come up with a whole new series of rules to help you do just that. Here to talk you through all of that, Nick Bruning, independent financial advisor, founder and director of Bruning Partners in Perth. Nick, good evening. Welcome back.
Thank you, Philip. Yes, very interesting stuff, this early withdrawal of super.
Yes. Are you in the camp that says that we're saying it wasn't... Look, I mean, people were in desperate circumstances, but a lot of financial advisors were saying, yes, but this is long-term disaster for a lot of people.
It is, and it did very much depend on your circumstances. And let's not forget that at the time all this stuff erupted, no one quite knew what was coming in front of us. So certainly your numbers are right, more than 3 million people. The average payout was $7,673, $36 billion. And look, the research showed that most of that money was put to good use. And we're talking about things like paying down credit card debts or servicing the mortgage. There was a couple of sort of things going around about some people using it for gambling and buying clothes and stuff, but in the main it was sensibly used. But as we found, for some people the lockdowns weren't quite as long as they thought, and in fact many businesses were able to continue throughout the lockdowns, and so what we ended up with is some people that withdrew their money, and just to remind people, it was $10,000 tax-free in the 2019-2020 financial year, and then you could do another lot of $10,000 tax-free in the last financial year, 2020-2021. You needed to do it by the 30th of December, and then, you could pretty much do what you like with it. But interestingly enough, a lot of people found that they didn't need it. It's been sitting in their bank accounts, and they've been looking to see whether they could put it back in. Now, the reality is you can anyway, but the issue was whether or not it triggered the contribution caps. So just for everyone's benefit, there's a limit to how much money you can put into superannuation. The stuff where you can claim a tax deduction, we call that the concessional contribution, is capped now at $27,500. And for non-concessional, which is where you don't claim a tax deduction, you could put in $100,000. But the new guidelines at the ATO, and this flies on the back of the May federal budget, where the government's keen to get that money back in if people can or if they want to. And so what the ATO have now put out is the guidelines on recontributing the money without triggering any of these cap issues. So in other words, whatever you took out, you can put back in. You can't put in more than you took out, so it's not sort of a free-for-all. Mm-hmm. And the other thing is that you've got until 2030 to do it. So you don't have to rush around and, get the money together now and put it in. So it's a fair bit of leeway. You've got, 8-9 years to get that money back into super if you want to. So there's a form that you need to fill in, usual bit of ATO paperwork. But the super funds should all now have them, and you can contribute it back to the fund. You don't actually have to put it back into the fund the money came from, so that's something else that's different too. Because what we also found is that people that did access their early super often used it as a trigger to close down one of those small funds they might have had lying around the place. So the fund might not actually be there anymore. So it could go into another fund if you choose to. I guess the issue is, should you do it? And you mentioned before, there's two schools of thought. One is that you shouldn't have taken it out at all.
In the first place,
yeah, exactly. And the argument goes that, well, that money taken out, we ran the numbers, and let's just take a 25-year-old that took out the $20,000, sensibly invested, and we're talking probably a high growth type option because they're not able to get their super for 40 years at 25 at least. That would have translated to a loss of about $230,000 to the age of 67 if the fund earned 7%. So that's a lot of money for the $20,000 that's come out.
Yeah.
It is. And, I think the government had one eye on the future impost of pensions and the cost of retirement income, for not my kids, your kids, maybe our great-grandkids, and the impact that would have on future budgets. So, it's not mandatory. It's there if you want to make use of it. But there's plenty of people that did, very sensible things with it. But for those that have got it casually lying around, if you're lucky enough to have that, here's an opportunity to stick it back in.
That's true. I mean, although for most people, Nick, that wouldn't be the case. I mean, how many people, if you took out $10,000, say, how many people have got $10,000 lying around just to put it back in again?
Well, they haven't. They probably haven't, Philip.
I mean,
That's exactly right.
People, most people don't, do they?
Yeah, no, but you do have the ability to do it over the next 8 years. So,
and
as
even that would be worth doing, wouldn't it?
It would. Yep. Look, the closer you are to retirement, the benefit's less because you don't have that compounding effect, right? And let's not forget this is over and above the current limits that also apply to superannuation. So it's really going to help someone that's got 100,000 to put in or 110,000 to put in. Good luck. So it's not going to affect that many. But look, it's a concession that's made. If you were going to put the money back in, I would probably make use of this rule. Fill in the form, and then at least you've preserved your other amounts that you can also contribute to super later on. Bearing in mind, 9 years is a long time, Philip. Things can change to 2030, and your circumstances might mean that you're in a position where you can stick it in.
It is one of those things, isn't it? That you, I mean, I remember what it was like in my mid-20s too. You think,
You've got a good memory.
Well, I do remember thinking retirement, superannuation. I mean, come on, give us a break.
It's true. But, exactly.
But, of course, when you get to the other end of it, you think, I wish I'd done that.
Yeah. No, I think people are becoming more aware of super as, it's one of those things that as the balance builds, you start to take a keener interest, don't you? Sort of once you're into your 30s and you've got maybe tens of thousands of dollars invested, you start to get very interested in what your superannuation's doing. So you're right, it is a function. And a lot of people would have seen it as an opportunity to use that money elsewhere. And look, there's a compelling argument. If you're paying 19% on your credit card and you can get this money and save yourself 20% interest a year, that's more than the super was probably going to earn in the short term. So there's a valid argument to use it to pay off debts and things like that.
Yeah, exactly. So if you can put it back in, then do so. I mean, no one's thinking you'll have the lump sum to put it back in, but if you get up your contributions.
Yeah, dribble it in. Get the form filled in, and then that
because your employer will be if you have got a job, your employer will be putting money in.
Yeah.
But above and beyond that, you can put in up to $27,000 a year.
Yeah, no, that's including what the boss pays.
That's what I mean, including what the boss pays.
Yeah, exactly. $27,500. It just went up from $25,000 last year, and also I think from 2022 as well. It's
so
from
if your boss put in
$0.
10, if your boss put in 10, you're allowed to put in 15.
Yeah, 12, 17 and a half now.
Sorry,
because of the new rules.
17
yeah. Yeah,
why am I
good.
reading these numbers, Nick? You're obviously...
I've got a calculator here. Yeah. Look, I mean, it's a minefield, isn't it, how much you can put into super? Because there's other concessions too. There's a little trick that if you haven't made use of your $25,000, now $27,500, and you've got less than $500,000 in super, you can actually bring back some of the previous year's contributions and stick it in, which is very handy if you've got some capital gains you want to get rid of, those sorts of little tricks.
And Rachel's got a question for you, Nick. Hi, Rachel.
Hi, Rachel.
Hi. I'm just wondering, I heard you talk earlier saying that is it still possible to draw on any of that super still?
Rachel, it's not, unfortunately. It was a special concession for linked with COVID-19 that closed on December. However, if you are in dire financial straits, there are mechanisms where you can access your superannuation. It's not quite as generous in terms of tax and stuff, but if you contact your super fund and, if you're in severe financial hardship and people are about to foreclose on your home and all sorts of dreadful things are going to happen, there are other conditions of release with superannuation where you can access it under special hardship conditions. I have to say, though, the rules are pretty tough. I mean, the way the government looks at super, it's there primarily for your retirement. Things happen along the way which are catastrophic, and so there are mechanisms where people can access super. But bear in mind, you do pay tax when you access money that way, and there are limits. But the special COVID thing has been shut down for now, and I don't think there's any plans on reopening it.
Well, okay, can I ask another question?
Sure,
yeah.
I did salary packaging.
Yep.
Now, I stupidly, with this COVID, took out a couple of silly loans, and I want to borrow money to pay that off, but they can't see the money that I put away before the tax. How yeah.
Oh, so are you having trouble getting a new loan? Is that the issue?
Yeah, but it's because the people that I try and get loaned through, all they can see is the money after the salary packaging amounts being taken out.
Well, I mean, it does depend on how the lender assesses things. If the salary packaging can be turned off, in other words, you can say to your employer, well, I don't want to package the salary anymore, and it just becomes gross salary, then perhaps the lender will assess it. Have you tried a mortgage broker? Those are the sorts of things that sometimes they can be quite useful with.
Oh, no, actually, no.
Yeah, so the finance brokers that are out there often have access to different lenders and your primary banks and stuff, and sometimes you can do what you're talking about. Just be careful about the interest rate. You don't want to be paying ridiculous interest rates to get a loan. But I guess that's the thing. If you've got some loans which are really expensive and you want to replace it with another one, then that's that's the way to go about it. Mortgage brokers or finance brokers. The other thing you can sometimes do. Do you have a mortgage, Rachel, or not?
No, we don't actually.
Yeah. Okay. Oh well, that's another way is to sort of. Sometimes if you do the numbers, you're better off taking some redraw on the mortgage and using that to pay off some of the more expensive loans. Providing you keep the payments up, you end up being better off. But the other thing, I mean, if you're really finding it really difficult, sometimes it's worthwhile having a chat with the financial counsellor. It's a free service. It's funded by the government on 1800 007 007. So 1800 007 007. You should remember that even if you're driving, and you can meet with them, and they'll often tell you ways of restructuring things that you might not be aware of. There's even things like interest-free loans and stuff that you can get through financial counsellors if you're finding things really tough.
Okay.
All right. Thank you very much.
Good luck with it, Rachel. Thank you. Appreciate the call. Dean says, when you put money back into super, is it tax-free to put it back in, or does it get taxed?
Yeah, it is.
Or does it get taxed at 15% again when you put it in, or have it deducted from your pay?
Really good question. So if you've just paid it in with after-tax dollars, it goes in as what's called a non-concessional contribution. So the beauty part about that is that no tax is taken out, no contributions tax. The only time you cop contributions tax is if someone's claiming a tax deduction. So what we're talking about here with the COVID recontribution is after-tax money being paid into super. So salary sacrifice, putting it in that way, that's not what we're talking about. Salary sacrifice would still be salary sacrifice subject to the 15% contributions tax because effectively it's a tax deduction for your boss.
So what's the best way to put it in? Salary sacrifice?
No, just pay it straight in. Write out a cheque, straight be paid, whatever. Yeah, it's done with after-tax money, Phil. So it would be money that you've got in your bank already. Okay. And you pay that in and then fill in the form, and that way it's not counted as a normal contribution. Okay.
Francesco, hello.
Yeah, hi. Evening. It's just a question relating to paying a refundable accommodation deposit as a lump sum in part.
Yep.
And its impact on the aged pension. A simple scenario: mum's likely to need to go into aged care.
Yep.
Single aged pensioner, owns her own home. Say she's got $500,000 in assessable assets.
Yep.
And if the accommodation deposit was, the RAD was $800,000, and she was to use half of that, $400,000 as a lump sum to go in.
Yep.
Would that reduce? Would that allow her pension to increase because her assets have reduced by $400,000?
Yeah, that's how it works. So the RAD. And again, it gets very confusing because you've got the way that the health department calculate the means tested daily care fee and accommodation fee, and then there's the Centrelink side of things, and Centrelink's quite different. So the RAD, as far as Centrelink's concerned, or the amount that you pay towards the RAD, is exempt from Centrelink's means testing. Your primary dwelling, and I'm pretty sure the rules as they were when last time I looked at this, is your primary dwelling is exempt from Centrelink means testing for 2 years, okay? So the house won't count for 2 years when mum moves into this facility. So the numbers are pretty good. If mum's asset tested, and it sounds like she would be, every $1,000 you're over the threshold reduces your pension by $3 a fortnight. So, you put $100,000 into the RAD, then in theory your pension could jump by $300 a fortnight. Now, if you put $400,000, it doesn't mean you're going to. You give me some of the numbers, but I have to work it out.
Yeah.
It won't go to $1,200 because the maximum pension you can get is about $953 a fortnight. So you can't get more than the full pension, but nonetheless, it would make quite a difference. So, worth looking at.
But,
and of course,
but am I right? Understand, but am I right in saying it seems that you're better off, those that have got the money are better off paying as much of the RAD as they can because it's refundable, whereas those poor people who don't have the money, they've got to pay a daily fee which they don't get refunded.
Well, there's different systems.
Gone.
Yeah. The system sort of looks at how much you've got in assets to work out how much you're going to pay. So you've got a RAC and a RAD. The refundable accommodation deposit is for people that have got, sufficient means to fund their accommodation costs. And just for everyone's benefit, it's like a bond that you pay in. They won't like to have it referred to as a bond, but you pay in a lump sum of money. Generally speaking, it's capped at $550,000. That's the most that you'll pay. There are some places which have got a swish view or something like that where they can get approval to go beyond the 550.
850,000.
Righto, so it must be a very swanky place. But whatever the RAD is, if you pay that full amount, you're correct. The facility basically has an interest-free loan for the period that mum's in there, and then on her leaving the facility, and usually, let's be blunt, it's when mum passes away. Once the documentation's provided, the facility's required to refund the RAD within 14 days in its full amount, and it's actually guaranteed by the federal government. So it's a pretty good deal. And over that period of time, then mum might qualify for a full age pension as well. If you don't have the full amount, then basically the shortfall, they multiply it by an interest rate, which is about 4% or thereabouts. You can choose to pay that shortfall as a sort of a monthly payment. It's calculated down to a daily amount, but you can pay it each month or so, whatever you like, or you can have it erode the RAD that you've paid in. So instead of 400,000, if mum's there for a few years and you don't pay anything for it, you might get a refund of 300,000 or something like that. But those are the choices that you've got.
Great, thanks.
Thanks, Francesco. Good on you. Hello, Richard.
Okay. My son has moved overseas in Canada, and he's been there for 3 or 4 years, and he's not coming back, and he has about $27,000 in super. Can he get that back, or what should happen there?
I don't think he can, Richard. Now, it's a good question. We often get that with people that are backpackers or whatever wanting to leave Australia, where they're here as a temporary resident and going back. I think the view is, and I'll stand corrected, is if your son's an Australian citizen?
Yes.
Right, okay, then I think you'll find that the normal conditions of release will apply. So he'll need to wait till he's 60 years of age. If he finishes work after that, then he can get his money. Now, it could be wrong. Sometimes there are arrangements with other countries. For example, we have a unique arrangement with the New Zealanders for KiwiSaver and transferring benefits across there. I'm not aware of any with Canada, but generally speaking, if he's an Australian citizen and he's got his super fund here, generally he'll be needing to wait until he gets through to retirement.
Not a problem.
Be accumulating nest egg for him, Richard.
We should have took advantage of the 210, shouldn't we?
Well, maybe, yeah. The circumstances, I don't think they're being repeated as we speak, I suppose, but I don't think they'll be opening up the super again in the near future.
Not a problem.
Yeah.
Right, thank you very much.
Thanks, Richard. Bye-bye. Dean says, no, not Dean, we've answered Dean's question. An unnamed texter says, if the share market experiences a sudden shock, 5 to 10% drop, would my contributions drop by 5 to 10%? No.
No.
How do I protect my contributions from the effects of a recession?
Well,
if you know the answer to that, then please,
it's pretty easy.
Tell Nick and I, and we'll be disappearing in a yacht to Monaco.
Yeah, well, actually, Philip, it's a really, really hot topic at the moment because every night now, well, not every night, but for the last few weeks, we've seen headlines that the market's topped all-time highs and all these sorts of things, and it's really starting to get quite frothy in the view of many people out there. One of the very interesting measures we sometimes use to check the share market's health is a thing called the price-earnings ratio, or the PE ratio it's called. And generally speaking, it sort of sits in a range between 10 and 20. When it goes below 10, it's kind of telling us that the market's cheap at the moment, or a particular share might be cheap at the moment. It's priced compared to its earnings. And when it sort of goes above 20, you're kind of thinking, well, it's a bit overpriced. I'll probably, maybe the earnings will come up to match it, or maybe the share price will fall. Do you know that the ASX All Ordinaries currently sitting at a P of about 26, 27? It's very high in historical terms, and it goes back sort of, I was looking at a chart today that goes back to 1980, and it sits between that 10 and 20 range, for the last 3 decades. And we've got this massive spike that occurred in the last 6 months, and it's sort of come off a little bit now, but it's still pretty high. So we've been saying to people, look, if you've made profits, now's a really good time to perhaps looking at taking some of those profits, putting it into something safe. Now, to answer our texter's question, the reality is the only way you can protect your money is to be actively in there and making the changes I'm talking about. The only safe option is to have your funds in cash. And what are you going to get on that? 0.4%.
That's right. If you're in practical terms, with many people in industries funds, for example, if you are and you're in a balanced fund, which a lot of people are,
yeah,
there's not a lot you can do, is there? Other than actively, as you say, just stick it all in cash.
Well, yeah, but you can also dial your own up. Now, most super funds these days, and look, I get the idea of what we call diversified funds, where you go in and let them do it. That's what you're paying them to do, and generally speaking, they've done a pretty good job. But the fact is that when you get a market correction, if it occurs, they're going to be hit. So it's particularly relevant, perhaps, for someone that's getting close to retirement. So what we always like to say to people, look, as you're getting there, and you've got enough, and you've got, we do the sums on Centrelink, how that's going to work in with how much you've got. For most people, it's about being sensible and being a bit more conservative. So instead of having in a balanced fund, you typically have 60 or 70% of the money exposed to riskier type of things, shares and property and stuff like that, and 30 or 40% in safe stuff. You kind of flip it around when you get close to retirement. We like to see people with 70% of their money in pretty safe things and only 30% in shares. So that's the trick, if you like, Phil, is to sort of, as you get closer to retirement, you work out how you place, and then you start making some adjustments. And you're right, you do have to go online to your super fund and make some changes to the investment options. It's pretty simple to do. It's not sort of, you don't need to be a rocket scientist to figure it out. But hopefully, if you're having a talk to your super fund, or if you've got a financial advisor, that's the advice that they'll be telling you. And some super funds actually, as you get older, they change and mix themselves automatically. You'll see some funds talk about life stages. So, born in the 50s to 60s, this would be the sort of mix. And if you're born in the sort of this millennium, then you get a different mix, which is slightly more risky.
Let's take a few more questions. Jane, hello.
Yeah, my question was, when you make contributions to your super fund, as you were saying, you've got up to $27,000 you can contribute. Mm-hmm. How does that equate to, I think you can make a tax deduction. How does that actually equate to a tax deduction? And what sort of ratio actually is it?
No, that's fine. So $27,500 is the cap, the limit that can be paid in one particular year. And it's generally made up of 3 common components. The first will be what your boss pays in. And from the 1st of July, that's 10% of your income, whatever you're earning, gross per month, whatever. So that goes in. That's part of the $27,500. Over and above that, you might have spoken to the boss and said, right, I want you to pay some money pre-tax. We call that salary sacrifice. So you might have said to the boss, take out $100 per pay and put that into super as well as a salary sacrifice contribution.
You take that out pre-tax.
Pre-tax. Mm-hmm. That forms part of the $27,500. Now, since 2014, you can also put in money yourself, and you can say to the super fund, well, I want to claim this as a tax deduction, okay? So that can form part of the $27,500. Now, the reason I say it can, you don't actually have to make your mind up on the spot. So some people do, but you might pay in $20,000 and then you get to the end of the financial year and you get a letter from the super fund that says, well, that $20,000 you paid in, Jane, do you want to claim it as a tax deduction? You might wander along to your friendly tax agent and she might say to you, well, Jane, look at this. Of that $20,000, we can claim 10 of it as a tax deduction. And that's what that's what you might decide to do. So I hope I haven't confused it too much, but there's what the boss pays in, what your salary sacrifice, and what you pay in yourself could be claimed as a tax deduction if you choose to.
That answers my question, but I also was wondering so if I do claim it as a tax deduction, what does that actually equate to? Like, is it dollar for dollar reducing taxable income, or what is it?
So it depends on how much tax or what income you're earning. But let's just say that you earned $50,000 per year after all the other deductions were there. So if you claimed $10,000 as a tax deduction, effectively what happens is the tax man's going to calculate how much tax you have to pay based on $40,000 instead of $50,000. And what often happens, if the boss has been taking out tax because they thought they were paying you $50,000 and you only end up really earning 40, then that means that Canberra's got a whole lot of tax that they've collected, which is yours, and it's more than you needed to pay. So what happens? You get a bigger refund, and that's the benefit of it.
Okay. Lovely.
Okay. Thanks, Jane.
Thank you very much.
Good on you. Bye-bye.
Bye.
Peter, hello. Hi, Peter.
How are you?
Not bad.
How are you?
Good.
Just a simple question, mate. Sorry, I'm on the hands-free. I just want to know why is it so cap? Like, why can't you put as much in as you like?
Why is there a cap on contributions? And why can't you put as much as you want? Yeah, so I'll pull your fader down a bit here, Pete, because it's a bit faint to hear you. But yeah, go on.
Yeah.
Nick.
The primary reason is because it's such a tax lurk. The maximum tax that you pay on money inside superannuation when it's earning, returns on shares or whatever is 15%. Now, the minimum tax rate that most of us pay is 19% once you earn more than $18,200. So you've already got a benefit there. When you get to retirement and you convert your superannuation from accumulation to pension phase, the 15% tax drops out. So you pay no tax whatsoever. You pay no tax on the earnings, and if you're over 60, you pay no tax on the money when you take it out. So it's a tax-free bonanza. So the government said, well, there needs to be a limit on this largesse. We're not going to give everyone, tax-free for the rest of their life. Who's going to pay for the hospitals and build the roads will be their argument. So there needs to be some tax collected. So as a result, we've seen caps on how much money you can put into superannuation. There's also a cap on how much you can transfer across to this tax-free pension thing. It's pretty generous, guys. It's $1.7 million each. So, you can have $1.7 million each.
As a tax-free pension.
Yeah, and pulling it out tax-free. So, a couple, that's $3.4 million. It's pretty generous. So that's the reason they limit how much we can use it. There was a time when you could put in, $1 million, I think, at one point back in the 90s, as a one-off, and many people took advantage of that. But those days are gone now, and that's it. Having said that, there are some concessions which allow people to catch up. Now, I mentioned the one before where you can bring forward previous unused $25,000 contributions. You've got less than $500,000 and put in, a big amount of, what's it now, $102,500, and claim the whole lot as a tax deduction if no money's gone into super in the past 4 years or so. So there's a few concessions for people that don't have as much in there. If their circumstances change, they might be able to take advantage of it, but then a lot of them can't.
Thanks, Peter. That's the reason. I mean, particularly for very wealthy people. It was just
great.
Tremendous lurk. That's right.
Yeah, it's fantastic.
Okay.
Protected from bankruptcy too. Did you know that?
Yeah, exactly. That's another thing. That's right. Protected from bankruptcy too. Yes. Peter, hello.
The question I wanted to ask was, I'm getting charged an advisor service fee each month of $661. Is that would that be normal, or is it necessary?
So the first question I'm going to ask is, do you think it's worth it for what you get? So you're paying nearly $8,000 a year.
That's correct.
Right.
And my super has gone up a lot, but
how much is it worth, Peter?
My super.
Yeah, total ballot. Yeah.
$650,000.
$650,000. Okay. All right. So $7,932 and $650,000 means you're paying well over 1% per year, which frankly, in this day and age, is pretty expensive, okay? Look, it depends on what the advisor's doing for the money. I can tell you that good advisors for that kind of money would be running all of the Centrelink stuff, probably doing most of your tax, and really holding your hand through retirement. What I see is some advisors are charging money where they're sort of running the super fund, but not really because someone else is doing it, but they're still charging these hefty sort of fees. So to give you, the alternative way, and that sounds like it's a percentage-based fee, to be honest, is that the genuine independents advisors don't charge that way. It's a flat fee. They don't care how much you've got. It's based on the work that's going to be done. And, if you win lotto, generally the fee shouldn't change, or it doesn't, unless there's more work involved. So those are the sorts of things these days that you need to look for. But that's why I asked, do you think it's good value for money? Things going up in value, to be blunt, it's not the fault or it's not the advisor can't lay claim to that, really. It's the markets that have done that. The share market's risen 27% over the last 12 months.
Yeah,
so
quite frankly, if you haven't made money over the last year or so, then
there's an old joke going around.
That's what I know, but I'm just saying, if I took the risk and got rid of the advisor, that would be the gamble I'd be taking.
Well, it would, but at $650,000, you're in a kind of situation where there would be Centrelink things to consider and tax sort of stuff. So, you might find that a lower cost advisor. Look, give you a ballpark. You're probably looking $3,500 to $6,000. I would have thought per year, and that would be full service. So, full service literally means the Centrelink and all that sort of stuff.
So if the advisor's only meeting twice a year, it's pretty high.
Well, and that's all that's being done is looking at the investments and telling you how well it's done. I reckon that's pretty high. Yep. Okay. So a couple of places really, to anyone looking.
The only thing that it comes back to is basically whether I take the risk. I mean, if I cut
get another advisor. That's the
one.
Yeah. That might be the choice. So there's a couple of, what I was going to mention, there's a couple of places to go and have a look at. First thing would be the moneysmart.gov.au website. We mention it quite a bit because that sort of tells you how the system operates. It's ASIC, the regulator's website, but it's a consumer-driven website and it's very, very good. At moneysmart.gov.au. The profession that I come from, PIFA, Profession of Independent Financial Advisors, pifa.org.au, we're the body that represents genuine independent advisors. There's not that many of them, but we don't care how much you got. That's basically what it boils down to. This is the work that's done, this is the cost it'll be, and that's the flat fee you're paying.
All right, Pete.
Right, but it's not a monthly, it's just a one-off.
No, it can be monthly. You might, but it doesn't change with how much money you've got. See, that's the difference. It's fixed, and it says it's going to be $250 a month, and that's it, Peter.
Okay.
Right up.
All right then. Thanks for your help.
Okay.
Bye-bye.
No worries.
It's a real challenge, Phil. I mean,
I know.
I've seen some outrageous fees charged by some people. You wonder what the hell they do for it.
Really? Well, exactly. They sit there and look at it going up. Wow. Yep. A couple of text questions as well. Grayman makes the perfectly valid observation. Limits on putting money into super, yet there's no limit on franking credits. Yes, well, Grayman, you are right, but then again, that's a whole separate argument.
Don't start that again.
Louise, why not?
That's right. You get 1 million retirees going nuts.
Louise says, Philip and Richard, not Richard, Nick. I'm still working at age 75 as a sole proprietor. Mm-hmm. The ATO says I can't make any super contributions any longer and get the tax benefit. I plan to retire in 5 years or less. She's 75, okay, good luck to you. But could still be increasing my super for my retirement. I'm earning the best money ever, and also have to now charge GST. It all seems so unfair, and I seem to be working harder than ever before. The government says work as long as you can, but takes away the incentives to do so. Is there something wrong with this picture?
Well, there is and there isn't, because I mentioned earlier on that the whole purpose of superannuation is to build a nest egg for your retirement. And they would argue that at 75, if you're still wanting to contribute to super, you're looking at the tax breaks for your kids and your grandkids or whatever.
It's not to build wealth, as it's...
No,
I mean,
it's
this is, I suppose, an important distinction. I mean, the point of the super tax concessions are not to build wealth so much as to build wealth for your retirement.
Exactly.
And the anticipation is you would use it for your retirement, not to build a wealthy nest egg to give to your kids.
Exactly. And people get caught out by this, Philip, because they put all their money and they realise, or they think that, at 65 I only have to take out 5% per year in normal times of my superannuation balance, right, if you put it into a pension. What they don't realise is that it goes up quite a bit towards the end, shall we say. And if you're a 90-year-old with money in superannuation, in pension funds, you're required to take out 11% of the account balance every year. And if you get to 96, good luck to you. I'm about to get a telegram from the Queen or whoever. 14% is the amount you're required to take out. So it's designed not to be there for your great grandkids.
Yeah. Shane, hello. Hi, Shane.
Yeah, g'day. Hey, how you going?
Pretty well.
Good.
My question is, we're a married family. My wife has been working, but just casual for the last 12 years whilst I've been working full time. My question is, you said before that you could top up your super up to 25 grand. I'm talking on behalf of my wife. Are we able to contribute as a family, as a couple, towards her super to make up for those years that she hasn't been earning quite as much as myself?
Yep. Good financial planning answer, kinda. You can do it a couple of ways, Shane. So the first thing that you can do is your wife earning less than about 40 grand a year?
Yes.
Okay, so you can pay money into superannuation and get what's called an 18% rebate, call it a tax refund, up to $3,000 that you pay into her super. You get $540 back in your tax return as an extra refund, if you like. So you'd look at that in the first instance. The second thing that you could do is that your wife could pay money into superannuation and claim a tax deduction for it personally. Now, where that money comes from, it doesn't matter. It could be from your income, but if you can reduce her tax, then that's a trick that you can do. Just be careful not to do too much. Now, it works out that if your wife's income comes below about $24,000, she wouldn't pay tax anyway. So there's little point in getting a tax deduction that brings her income below that. And the final thing, which a lot of people do make use of, is what we call spouse splitting. And this is where you can ask your super fund to transfer the money that went into your name last year as a tax-deductible contribution, which might be stuff that you've paid in or the boss has paid in, and you can transfer it to your wife's fund. You're limited, however, to the previous year's contribution. You can't split the balance. It's just what you paid in.
Right. And what would be the purpose of that?
Well, that allows you to boost up her superannuation balance. So if you're getting to a point in life where maybe your wife is older than you, she might be able to access it before you can at 60 years of age. Or it could be that you're in a position where you're getting close to these caps, the $1.7 million cap. Good luck to you if you are. In that instance, if your wife's got a smaller balance, then you could transfer it across to her. And the other one, which is a sort of a minor benefit, is if something happened to you, then, it'd take a while to sort out the super potential. If she's got money in her name, then, it sort of potentially could be accessed while they sort your stuff out. But that's pretty, hopefully, minor in the scheme of things. But certainly equalising the two balances. And I suppose that's the other thing too, Shane, is that, every few months we hear about some rule change to superannuation. Up until a couple of years ago, it didn't matter who had the money in super, but now with these new limits and balance caps and all this sort of carry on, it's actually better off both if you're having a superannuation balance in your own right. So just in terms of protecting yourself against rule changes, it might be an idea to try and equate the balances between the two of you.
Okay.
Yep, no drama. Yeah. All right, thanks for that.
Thanks, Shane. Bye.
Biggest risk of super, Phil? Yeah. Rule changes.
Yes. Speaking of which, there are changes to rules for adding extra members to a self-managed super fund.
Yes. Well, this, again, has been kicking around for a few months, but finally the legislation passed and the ATO have cleaned up some paperwork. But it allows you to lift the number of members of a self-managed super fund, which was previously 4, up to 6. Which is interesting because when you look at the stats, the number of self-managed super funds with more than 2 members is only about 7%. So you wonder of the whole lot, and we're talking 1 million plus funds now. Only 7% have got more than 2 members in the first place. I just urge a bit of caution. Self-managed funds, look, they're very popular with some advisors, and I guess they have a place. I'm not a big fan of them. I think they're overly more complicated than they need to be. I think you can these days get much of the same functionality in a self-managed fund with a public office scheme that's cheap to run. But that said, a self-managed fund has its benefits for people that might want to be investing in commercial properties and stuff like that. Mm-hmm. The problem with having more than 2 members of the same age is that you end up perhaps with, get the whole family in. You're going to have different objectives. So you might have mum and dad that are wanting to sort of calm down a little bit. We're getting to retirement. We want safe stuff. And you've got, 25-year-old Nick and Phil, the 2 brothers, wanting to put the money into Bitcoin or something like that. And so you kind of all have to agree on how the fund's going to be run. And I think that can create conflict. So, so again, some people use them as a tool for estate planning. I'm of the old school that just likes to keep things separate. Maybe mum and dad, but I'd be wary of having the kids involved.
All right. Speaking of which, John's on the line. G'day, John.
Hi, how are you?
Not
tonight?
bad. Not bad.
Look, I'm wondering if you've got some strategy. I've just done what you're suggesting I shouldn't do.
Sorry, John. Yeah.
12 months ago,
Yeah.
I've brought 3 of my children into the family SMSF.
Yep.
Right. The youngest of those children is 50.
Mm-hmm.
So that suggests to you that I'm probably older than 50.
Yeah, just a smidge. A child bride or something.
But is there any way that I can transfer my account balance to the children when I fall off the perch? I don't want to discuss it with them. They might push me.
Yeah, exactly.
Beware of the almond-flavoured milk, John. Yeah.
Yeah.
Yeah, well, it kind of does. I mean, you nominate the kids as the beneficiaries of the estate is how it's done. You can do a form inside the fund that nominates them as the...
But that's got to be in the trustee.
Yeah,
the super trustee.
Yeah, but there are forms, there's a non-lapsing binding death nomination.
Yeah.
Right? So you leave your share to the kids that way, and generally speaking, that means we won't have to be disposing of assets and mucking around like that.
Yeah, well, ideally, I would like to retain all the assets.
Yeah, well, you can do that. That's what I'm saying.
Only Australian equities.
Yeah.
Nothing else.
Yeah. So what your SMF advisor has probably got you to do is to complete forms that nominate your children as the beneficiaries of your super fund. And effectively,
I'm my advisor.
Oh, okay. Well, then you.
Or I try to.
Yeah. Okay. So if you've set up what's called non-lapsing binding death nominations, and it nominates that your kids are the beneficiaries of your superannuation, then the balance basically transfers to them. I mean, there's some technical things about how they receive the benefit and whether it comes through them as a pension or lump sum and all these sorts of things. But that's basically how it's done, is you nominate them as the beneficiaries.
Right.
Okay.
There's a couple of good books. Okay. There's a book, there's a lady called Monica Rule who's an ex-ATO auditor for self-managed super funds. I'll give her a plug. She's a Perth lady, but she's very good. And there's a book, Running a Self-Managed Super Fund by Monica Rule, R-U-L-E. I think it's only $20 or $30 or something, but it's really good about these sorts of technical questions that we see with self-managed super funds.
Okay.
Well, I know I've read a lot of articles by Meg Heffron.
Yep. Another good author. I know of her, but I don't know her. So,
all right, John. Good luck with it, John. Thank you. Jen from Bondi has texted me. Hi, Jen. Phil, can your guest please help? My husband's 74, I'm 70. We're retired, own our own home, have $1 million in the bank. Hardly any interest. Are we going backwards? I'm risk averse. I don't like shares. Will we be able to see out our life on this if we do nothing?
Yeah, well, it's a function of how much you spend per year. But at $1 million, well, if you're pulling out $50,000, that's 20 years worth, isn't it? So that makes you 94 and 90. However, at some point, if you
are
went
going
down
backwards.
you are absolutely.
Backwards,
Inflation's running at 2% and your bank's paying you 0.5. You are in negative interest territory. Yeah. Absolutely. So, look, the only real alternative, and I'm very wary about talking other things other than banks because we immediately move into a riskier area. Yeah. For goodness sake, keep away of anyone promising you, 3% and it looks like it's guaranteed and all this stuff. These are the sorts of the scams that we you end up seeing on the 7 o'clock news bulletin. There are these things called bonds, and I don't mean a bond. There are good bond funds, which you can get through the stock exchange. But in fact, what they are is fixed interest investments that are issued by governments and big corporations. A bond fund will have a mix of things, paying different rates, and sometimes the bond fund will trade it. Now, the returns aren't spectacular. We're not talking, you're going to get 5 or 6%. I think the good bond funds at the moment are returning somewhere between 2 and 4% because they're buying and selling these bonds. But they are safer than shares. I won't say they're completely risk-free. They suffer worse when interest rates are very volatile, but when things are reasonably stable, they tend to be fairly stable as well. What's interesting, though, Phil, is that sometimes when there's a big market correction, the money goes somewhere. It often goes into the bonds. So you often see a bit of a lift in those bonds when there's a share market correction. So, but you need to talk to a financial advisor if you're going to go down that path, stockbroker or someone like that who can assess the risk that you're prepared to take. And it might not be putting all of it in, Phil. It could be some of it, at least to get a bit of a return, hopefully above inflation.
All right, Jen. Question for Nick. The man whose son's in Canada, how often does he need to tend to that account to avoid it being lost? Well, it's never lost, is it? It's never lost.
No, it's not lost. No, I think we're talking about the protecting your super balances. Now, I think the threshold's $6,000 or less, and then there's a requirement to transfer it to the ATO, who will try and marry it with an active fund. If not, they keep it and pay a modest rate of interest. But it's generally done to sort of, protect people from fees and costs and stuff like that. But I think the $6,000, 16 months with inactivity, that sort of stuff. And we've had a few people sort of get scooped up by that. It's the first tranche, if you like, occurred in October 2019, and that created a huge ruckus because people's money was transferred to the ATO, but in that process it shut down some of the compulsory life insurance, and we had people that had $20,000 or $30,000 life insurance, and that was the only life insurance they had suddenly shut off because the money got transferred to the tax office.
Russell, hello, Russell.
Yeah, g'day, mate. How we going?
Not bad,
mate. I've got super in an Australian company that when it first floated, it was about $17 a share or something. Now it's down to about $5. If I keep on contributing to that fund, is it guaranteed by the government or anybody or?
So when you say that the company is a financial services company whose shares have gone from $17 down to $5?
Yes.
Right, okay. Yeah. I think we kind of know who you're talking about and no one's going to say it. So it's really important to understand that in these circumstances, the money that's held in super is in trust, right? They can't get their hands on it. And it's not about the fact that that company's not doing well, that your super's not doing well. Generally speaking, what happens is that these companies are often taken over, and the asset that's worthwhile is managing your super, which is the fees. It's not the money that's in your super. It's the fees that becomes valuable for someone that buys that particular financial services company. So your super, so it's not directly affected by it. I mean, the downside of it is when these things happen, good people leave and all the top flight fund managers bolt and go somewhere else, and suddenly you're left with people that perhaps aren't as good as they might have been. But by all means, look at the balance. I think you find it's probably gone up, but there'd be a good reason.
It's performed pretty well.
Right. I just
can't understand why it's so low.
Well, the company's low because it's had all sorts of strife through royal commissions and things. They're finding things very tough. And look, if you're concerned, and I would certainly say in those circumstances, I'd be looking at alternative funds at the moment, and certainly a lot of people are. They're moving their money out of that company.
Righto, Russell.
Righto,
Russell.
Thank you.
Thank you.
Yeah.
Yes. Where can we buy the Monica Rule book? Someone says it's hard to find online.
Okay. Well, I'll see if I can find it for next time.
All right. Have a
Google.
Have a hunt. Google.
I will.
Google.
Yeah, Google.
I'm surprised it wouldn't
Dr.
turn
Google.
up. It'll turn up somewhere.
I'll give you a title.
What age did you become eligible for the pension, says Rob from Perth?
66 and a half.
Because Rob's 60 and he doesn't have enough, he reckons.
No.
You've got to wait another 6.5 years, Rob.
Yes, mate. Well, no, for him it'll be 67 because...
he's 60 now. It'll be 67.
Yeah. Bad luck, Rob.
Okay, bad luck. Right, Nick, always a pleasure. Thanks for your expertise.
Thank you, Philip.
It's been fantastic, mate. Thanks.
Pleasure. Good on you.
You've been listening to a Nightlife podcast. For more great conversations about the issues that impact you, as well as features on travel and food, head to the Nightlife webpage. You'll find it at abc.net.au/nightlife. You don't need to be a night owl to enjoy the nightlife.